Good morning and welcome to this Wednesday, May 31st, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, looks like maybe the market is ready for a pause, or is it? Futures are pointing down. We'll see what happens once the opening bell rings, but right now we've got Dow futures down about 114, S&P 500 futures down 20, NASDAQ futures down 68. Crude oil prices down another $2.20. We're down to 67 and a quarter per barrel. Really steep drop here over the last couple of days. And the U.S. 10-year Treasury yield also dropping again today after losing about 11 basis points on Tuesday, down another 2.5 basis points today, 3.67%. So as we approach the opening bell, that's what we're looking at currently. But let's go ahead and jump right in to the action from Tuesday. See if we can gather any clues from what we might expect today. Also want to mention before I get into this that today is the last day. We've extended our spring special through the end of this month. I know that there were a lot of folks traveling, so we decided to extend it a couple of days, but this is it. Today's your day. Midnight tonight, it's over. We've had a very successful special. I wanted to thank everyone, all of our members, new members, existing members that extended. We had some really good terms where you can extend. The further you extend out, the more you actually get in terms of free months. So you can really lower your monthly cost of our service by extending out a little ways. And we'll talk about that a little bit more, but I do want to just make sure everyone's aware today is the day. So May 31st, midnight tonight, it'll be over. All right, taking a look at what happened yesterday, we saw some kind of movement to the downside early, tried to recover a couple times, didn't really do it, finished, I don't know, fairly low on the session, or at least lower than we were earlier in the day. Dow Jones Industrial Average finished down 50 points. That was about 0.15%. S&P 500 was flat on the day. NASDAQ was up 41, but it was up a lot more at the open on the debt deal that was struck over the weekend between President Biden and McCarthy. So anyway, we did finish up about 0.3%, but that was quite a bit off of the earlier high. Mid caps down 2.48, almost 2.5 points. That was 0.1%. Small caps fell a little bit more than 5.5 points, and that was about 0.5%. So really not a great day. I guess you could look at the NASDAQ and say, hey, we were up, but it was all well off the earlier highs. And this, we've had such a big run, especially on the NASDAQ. You can see this, it's almost been parabolic here during the month of May. I guess that was for all those go away in May folks. Talked about growth leading starting in the month of May, and that's really what we've seen so far this month. NASDAQ having a huge month. So is it time to pause? Well, I mean, short-term overbought. Anytime you're short-term overbought, we could have a pullback. I think to the downside on the NASDAQ, I'd be watching the 20-day moving average. I would certainly not expect it to fall more than that. Even down there, we're probably looking at about 3 to 4% drop from here. But what we've made here during the month of May, I mean, 3 to 4% to the downside really wouldn't be that big a deal. Looking at the sectors, we had discretionary stocks leading yesterday, up 0.2%. Technology up a little over 0.5%. Real estate up 0.3%. Communication services up a little less than 0.2%. The big loser yesterday was Staples, down 1.14%. I find it interesting that on a day when we saw the Dow down and the S&P flat, that discretionary was the top performing sector and Staples was the worst performing sector. Growth versus value. Aggressive versus defensive. Usually when you start to see pullbacks, you see the areas, the aggressive areas that led the advance start to get hit to the downside. That was not the case yesterday. We'll see what happens today. I think the bears have a much, much better chance of a lengthier pullback if the aggressive groups were to begin to sell off. Not really too much yesterday, even though we did close off the highs of the day, but still up is up, and discretionary has been really crushing staples of late. Month of May, especially if you check out May, look at the XLY going up. Come over here to the staples and look at what's been going on, straight down. So there's been significant rotation out of defensive groups into aggressive groups. That's a really bullish signal to me. When the market topped at the beginning of 2022, it was the exact opposite. We had money rotating big time into staples and out of discretionary. Wall Street, the big Wall Street firms were preparing for a move to the downside. I don't see it right now. I just don't see it. Could we go down? Sure, we're overbought. We could go down, but we really need to continue to watch the relationships here, intermarket relationships. And right now, it's not suggesting anything bad. Moving on to the 10-year Treasury yield, we did see the drop yesterday, big drop, as I mentioned, 11 basis points. Today, we actually went down and tested that 20-day EMA to the upside, and it's been moving up. Now, we've had a lot of false breakouts. We've had some false breakdowns. We're kind of meandering mostly sideways with maybe a little bit of a downward slant to the picture. That goes back all the way to October when the S&P 500 began to make a big move. The NASDAQ also held its October low, but it really didn't get going until January. The S&P started jumping, though, in November and December when rates started to come back down. Last 5 or 6 months, when the NASDAQ's really been making its move, 10-year Treasury yield's been flat. We haven't really done a whole lot. The net, I mean, we've had some ups and downs, but literally we're sitting almost where we were to begin the year. Do want to mention that as far as economic reports go, we do have the May Chicago PMI coming out a bit later this morning. April was 48.6. We're expecting that to drop to 47.0. We'll see what happens there later in the day. Also, this afternoon, we'll get the beige book. I think that's out at 2 p.m. Eastern. All right, so looking at the S&P 500, we haven't had nearly the run in the S&P as we've had in the NASDAQ. A lot of that's because, as I mentioned, NASDAQ is more growth-oriented. We've got semiconductors that have been exploding to the upside, software exploding to the upside, internet stocks exploding to the upside, automobiles beginning to pick up. We've got broadline retailers starting to go now, including Amazon. So it's been some of the stocks that are more heavily weighted on the NASDAQ that are leading. And so we've got the S&P still in a nice uptrend off the October low, but the S&P still has a big resistance level at 43.05. I think that is going to be the big level to try to get through. I believe we're going to do it eventually, but it's going to take probably a little bit more rotation into some areas that have not been performing well. And that's what I'm going to be looking at. When we get that first big pullback in technology and communication services and discretionary, does that money rotate over into some of the areas that have just been beaten to a pulp here of late? Staples, utilities, energy, materials. We're going to talk about some industry groups in those areas a little bit later in the show, but that's what I'm going to be looking for. We know the QQQ, the NASDAQ, is not going to just continue unabated forever and ever. We're going to get a pullback at some point. It'll probably be somewhat significant. Like I said, 3, 4, maybe even 5% wouldn't shock me just because of the magnitude of the increase that we've seen. But what happens when that index pulls back? Does it rotate or does it just leave the market? Do we see selling in areas that have been selling? Or do we see that money rotate? Money rotating would be much more like what we normally see in a bull market. If we see full out selling everywhere from start to finish, not just gap downs, we've been through this. So this morning, yeah, we've got futures down. Do we sell off during the day? I think that's going to be a pretty big question. So those are questions I'll be looking for answers to decide whether or not we're really ready for a pause, whether we're going to see some rather significant selling, or whether or not this is just temporary and we're just going to keep going to the upside. I will say bull market advances, when they get going, they take no prisoners. They just keep going. So what we've seen in the QQQ really is not that unusual when it comes to bull market advances. So here's the NASDAQ, and there's that advance I'm talking about. So on the last pullback, beginning of May, we went down and hit the 20-day. We were sitting just below 13,000. We're up 10% this month since then. So not for the month, but since those first few days in May, at that low, we're up 10%. That's a huge month. And we've talked about how May, June, July, and August, those 4 months are when growth stocks do all their damage versus value. Damage in a good way. Growth stocks love May through August. Historically, growth has outperformed value throughout this secular bull market that started back in 2013 by close to 5 percentage points per year. And it's also up about 5 percentage points versus value in just the next 4 months. The rest of the month, pretty flat. This is where growth stocks make their hay, May through August. And that's what we're seeing. We're not really seeing anything out of the ordinary. Maybe to the extent it might be a little bit out of the ordinary because the NASDAQ's been so strong while the S&P 500 is moving up but kind of languishing a little bit. So maybe the extent of leadership is a little odd, but the timing of it certainly is not if you follow history. All right, I'm going to show you the chart of the day, but before I do, I want to mention a couple things. If you go over to earningsbeats.com, here it is, our best deal of the year. This is our spring special. You can click and save over 50% on membership through today at midnight. The longer you commit, the more you're going to save. So if you join, sign up for 1 year, you'll not only get your 30-day trial, but then you'll get 2 bonus months. So you can actually make it 15 months for the price of 12. The 2 years, you got 2 years, we're going to give you 6 free months. And if you got 3 years, we'll give you a full year. Full year free for 3-year commitment. So you can see the total cost comes down quite a bit, or the average monthly cost. And if you just sign up for Earnings Beats for our service, it's normally $147 a month. So you can see the savings by extending. So make sure you check this out. You know, we want our members to be happy over the long term. It's the best price, I think, for what we've done, calls we've made, the services we offer, the research we provide, $62 a month. I think that's pretty good. Anyway, you've got the form down here to sign up. Just make sure under subscription plans, you pick the plan you want. It's as simple as that. Love to have you. All right, chart of the day. So this is the one that I put in the Earnings Beats Digest today. And by the way, if you are over at Earnings Beats and you scroll down at the main page, homepage, you can sign up for the Earnings Beats Digest right here, name, email address, and then you'll get our 2 paragraphs in the chart mailed directly to you. All it takes is name, email address, hit that subscribe button, and you're good to go. Monday, Wednesday, Friday. So that's over at our main homepage. So let's take a look at Costco. So I'm going to annotate this because this is a continuation pattern. And in order to have a continuation pattern, the first thing you have to have is a prior trend. You can't continue something if you don't have anything to begin with. So you've got to have a prior trend, either up or down. In this case, Costco, for about 3 years, very, very nice uptrend. And so for the last year, a little over a year, it's been consolidating. And it's been consolidating in this symmetrical triangle. And the thing about a symmetrical triangle like this is that the triangle is pretty wide to start. And then notice how it just keeps squeezing and squeezing. Now, for those of you who are familiar with the ascending triangle, this normally would start like right here. And what you would see is equal highs. You would see these highs continuing to come up and bump up against this overhead price resistance level. And then you would see rising lows. So in this case, you would see something like, that. That's an ascending triangle. Equal highs, rising lows. Well, symmetrical triangle is just a little bit different. The triangle just kind of falls a little bit off to the right. Looks maybe a little bit like a flag, like a pennant. But you've got the characteristics. Key characteristics are you've got lower highs, which you can see with that up or down trend line. And then you got higher lows. And this is that lower uptrend line. And so there's your squeezing into this triangle. And look at the volume pickup with earnings on that breakout. So I really like Costco right here. It could be a false breakout. So you've got to kind of watch this trend line down here to the downside. Make sure we don't lose about 475. But otherwise, I think Costco looks really good. I really like the breakout here. I own some of Costco on this breakout. And I'm expecting it to go back to the 600 level eventually and higher than that. But based on this pattern, that would be the initial target for me, would be up to 600. So you got to be familiar with these patterns, recognize them. They don't guarantee you anything, but they do increase your odds. And that's what we try to use technical analysis for. Try to use it to increase our odds, to manage risk, not to produce guarantees. Folks that don't believe in technical analysis, the big problem is they set the bar too high. They go in thinking, oh, that if we got a triangle and it breaks out, it has to go higher. Well, no, it doesn't. It's just increasing the odds, recognizing the pattern. All right, let's move on. I want to go over some of these industry groups for a little while. And so I'm going to start off first in the energy space. And so I wanted to go through the charts here. And the first one I want to go over with you is the pipeline index. So as we know, energy has really been struggling. For a while, for most of the secular bull market, it was horrible. And then it woke up after the pandemic. Remember during the pandemic, the price of oil, crude oil, went negative. Basically, if you had an empty pool in your backyard, they'd pay you to put crude oil in it. That's how low crude oil prices went. They went negative. Well, after the pandemic, when everyone realized that, hey, it's a healthcare crisis, it's not really the financial crisis that everybody thought it was going to be, crude oil prices came rebounding back. And as they came rebounding back, we had a big run in energy. Energy was one of the best performing groups for a couple of years. Well, that's changed again. Now we've got crude oil prices dropping and pipelines, which put in a double top back in April and June of 2022. Remember that cyclical bear market we had first 5.5 months of 2022? Yeah, energy did really well. But since then, since the stock market's been rebounding overall, you can see pipelines have really struggled. Now, if I look at this and I draw you a little trend line here, I think it's pretty clear that we are at a fairly significant support area. I mean, I would say anywhere from about 602 or 3 down to about 590. And we're in that range right now. So a couple things to look for. Number one, if you're a price support person, pipelines look like, hey, this is a pretty decent area. I mean, we're right in the major support area. We have not been below 590 since back at the end of 2021. And here we are at 604. I mean, we're pretty close. We were up to over 760. So that was more than 20% ago. So pipelines, I think we need to recognize that, hey, this is a major support area. Now, I'm a momentum trader. I like to trade momentum, so I'm sticking with the growth stocks. But for those of you who like to look for value, you like to try to find bottoms where, you're testing key support. This is a great time to be thinking about pipelines, because if the group breaks down, you can get back out fairly quickly. So that's pipelines. How about oil equipment and services? What are we up to there? Well, still got relative weakness all year. It's been going down. That's the group versus the S&P 500. And there's your absolute price chart going down, continuing to get lower lows, lower highs. Watch 240, but if 240 breaks, we really don't have a major support level until we hit that September low down around 190. So this is a group that, yes, it's been beaten up. I don't see any signs yet that would have me wanting to jump right in. Again, 240, you could play that, but I would be very, very quick to exit. If there's one positive here that maybe that holds, it's that on the way up over here. You can see that was a resistance area where we went back to a new low, and then we went up here, hesitated, and then broke above. Came back down very close to the 240 level in March, held, went back up to 290, and now we're back down here again. But this time we're rolling back over under the 20-day. Doesn't look very bullish to me. I think we're probably, in my opinion, I think we break down. So I could see this 190 level eventually coming into play. Next up, how about integrated oil and gas? Well, here it's not as bad, but I do see a trend line that's broken. I'm seeing failure at the 20-day. It's starting to act like a downtrending group. So what I was looking at before, you probably could draw a line from over here. Well, actually, we're still above that trend line. If you were to draw it, say, let's see, something more like that, connecting these two, then you would be just below. But one of the things that's bothering me here is the failure at that 20-day EMA right here. So you went up, you went above the TPO center line, been kind of going above the moving averages, below the moving averages, above, below. And so it's kind of given us that sideways consolidation feel. When your moving averages don't hold as resistance or support, then you're essentially in a trendless market. Moving averages are great to follow a trend. So when you're trending up, I love following the 20-day. Then if you fail or you have a negative divergence, maybe you go down to the 50-day, reset the PPO, and then you hopefully continue along that trend to the upside. When I start seeing failure on the 20-day, I start thinking more weakness. Kind of like over here, we came down, we went back up just a little bit above the 20, and then we broke to new lows. Here, we're coming down. We had one rally, couldn't get through the moving averages, new low. Move back up to the 20-day, can't get through, and now it looks like it's trying to roll back over again. So maybe watch this trend line. You've got recent price support around 700. That's where the trend line is right now. Break below 700, and I think you're probably going to lose another 10% in this index. Let's see. Let's do a couple more here. Next up, let's do exploration and production. If we look at what's been going on here just over the past year, you can see the top in June of last year, the double top in November. Are we going back down to test this bottom? Right now, it kind of looks like it, but 850 is going to be a very, very important level. And the reason I say that is if you go in and annotate, I think you can see this level held, this level it held, here, here, here. This is a pretty big area. The only one was July of last year where we actually broke below for maybe a couple weeks. But otherwise, 850 has been a pretty good support area. Now we got the PPO remaining mostly in negative territory this year. We've had a couple of decent moves, different moves to the upside, but if we take a look at the trend, I mean, I'm seeing mostly that. So unless we can get back through 950 and especially 1,000, which would be the most recent high, I'm seeing this as continuing to the downside. And again, we break 850, we got some issues. So technically, as I go through these various energy areas, if we don't hold up, if we can't hold support on these 3 or 4 indices I just showed you, you can see where the XLE could get hit pretty hard. And the XLE is still trying to hang in. At least, let me see if it's still trying to hang in. I believe it's still trying to hang in above support. Yeah, 75. So whether or not we hold 75 likely depends on those charts I just showed you. Do we actually make, do we have a breakdown on those various industry groups? If we start to see breakdowns on those below the price support levels I just showed you, XLE is not going to hold 75. And that could then take it back down into the ranges we saw back over the summer and early fall of 2022, 65 to 70. Maybe even 60, I'd say 65 to 67 and a half. But in the uptrend, the big scheme here, big picture, here's your higher high, there's your higher low, there's a higher high. That's a major low for the long term. You can say sideways consolidation for a while as long as 65 holds. You lose 65, then you're clearly into a long-term downtrend. All right, that is essentially what I wanted to go over. So I'm going to do something I haven't ever done. I don't remember ever doing since I've been doing this Trading Places Live here at Earnings Beats. I'm going to finish early, 2 or 3 minutes early. Watch some key levels. Like I said, the S&P 500, first thing I'd be looking for there is just this maybe trend line coming up here. I think a move below 4,100 would have some potentially more bearish implications because 4,100 was recent support. We've also got the 50-day moving average now up at 4,105. So we've got about 100 points to the downside, which 2.5%. I wouldn't be overly concerned as the market, if we were to pull back in that fashion. On the Dow Jones, it's been weaker, definitely weaker. I'd see, off of this low and this low, we're probably maybe already below a trend line. Of course, it's only connecting 2 points. But from a bullish perspective, you want to get back up above the moving averages. From a bearish perspective, if we can't get through those moving averages, it looks like 3150 would be the area to watch. And that would be between 4 and 5%. And then the last one I'll show you, NDX, the rising 20-day, which right now is 13,632. That's going to be your first area of support, and that's about 600-700 points below where we are. So we're looking again 4 to 5%. So, with the run we've had, if we drop anywhere in that 3 to 5%, I don't think that would be a bad thing for the market. Anyway, that's it for me. We're going to see where we go here in just a couple minutes and see what happens throughout the day. But in the meantime, everybody have a great day. I'll be back over at Stock Charts TV on Thursday for your next Trading Places Live. Just go over here and click on this at 9 a.m. tomorrow morning. And love to see you. Happy trading, everybody. Have a great day.
Hello, thanks for watching the video. If you enjoyed this content, please consider liking and subscribing to our channel. If you want notifications pushed to your phone anytime we post a new video or we go live, please click the bell next to the subscribe button also. Thanks.